privilege to invite Mr. Chandrashekhar ji, whose long-standing engagement with global commodity markets brings valuable perspective on the macro signals, policy shifts, and their implications of metals. Over to you, Chandrashekhar ji.
Thank you, of course, for the welcome speech and welcome all my co-panelists and, of course, the participant. It's such a delight for me to be part of this. And this is an ongoing activity which will continue. Thank you very much, Chaya. Who will move the slides? Can I move it from here or no? Okay, let's go to the next slide. I'm going to discuss global economy and of course the impact of the aluminium market. Very clearly, I think I've been given about 15 minutes, and I hope I'll complete in 15 minutes. Disruptive decade. I call this decade a disruptive decade because 2020 and 2021 we had the pandemic and lockdown. 22, 23, 24, 25. The ongoing fifth year of the Russia-Ukraine conflict. Then we also had the Hamas-Israel conflict for 2 years. Now we have Iran, Israel. In the meanwhile, one Mr. Trump came to the White House, and then with tariff he disrupted the world economic activity. All of that. So I call this a disruptive decade, which is characterized by VUCA, which is volatility, uncertainty, complexity, and ambiguity. And when I look back on my own presentations, and particularly with Abhinav Verma, we have done so many events over the last 15, 20 years. On numerous occasions, I had the chance to talk about VUCA world, because the world has been facing these extreme volatile conditions over the last 10 or 12 years, barring some brief periods of peace and tranquility. Let me put it that way. So geopolitical instabilities, geo-economic uncertainties are seen affecting the growth momentum, particularly in 2026. This was not the case until about 2 months ago. In December, we did one event. In January, we did another event looking at the first half of 2026, the global metals market. What were the key themes that we discussed? Optimistic global economic outlook. And we found the US's tariff risks were actually abating, even as the US struck deals with South Korea and Vietnam and Japan, etc. And the global trade risk, obviously, early this year started to appear much less threatening than they were, say, in 2025. Liquidity conditions were expected to turn favorable with the possibility of a drop in interest rate, etc. Next. Therefore, fairly optimistic beginning. Next slide. Fairly optimistic beginning to the year. Yet over the last 15 days or so, there's a huge transformation. How things change so rapidly in this world. The latest Iran-centric conflict has once again elevated the uncertainty in the marketplace, and the impact on the global energy market, as all of us know very clearly, is phenomenal. With Brent prices spiking massively, we know of supply chain disruption. We know of how the Strait of Hormuz is so critical for the movement of at least 20 million barrels of oil a day, which is now blocked. The movement of LNG, massive quantities, even that is, and therefore all this is affecting the energy security of various countries. Energy prices are rising. I don't want to get into the numbers, but we all know energy prices are rising, and that is certainly going to lead to inflation with a small lag. You can expect inflation to manifest itself certainly from by the end of this month or early April onwards, which in turn will have an impact on interest rate, which will have an impact on global growth rates, etc. We discuss all of this in the January metal trends and pigment event, but such a big transformation in the last 2 weeks or so. We don't know, at least I don't know, how long this war is going to last. how long this conflict will last, what will be the outcome, what will be the impact. I think it's very, very difficult to predict. And the question, therefore, is the world moving towards a new global order? Maybe, possible. Is the world fracturing into two or more blocks? We don't know. But that's again a possibility. For we need to, the market participants have to keep all these red flags in their mind. Next one, please. Next slide. Okay. Now, if we looked at 2025, the metals market posted very strong gains last year, 2025. LME index was up more than 20%. But remember, it was primarily driven by copper and aluminium. Okay, the different base metals contributed very differently, but substantially driven by copper and aluminium. Even early 2026 in our event, we said overall, most metals were most likely to be well supported in 2026 simply because of anticipated improved growth prospects, expected falling interest rate, and very significantly tightening fundamentals. Because many countries are now what is called resource nationalism. This is what they are practicing. Therefore, all this created an atmosphere that will be very positive for the metals. And more important than anything is China curbing its overcapacity in many metals, especially in steel. And of course, it has already set new limits on metals production. At least 10 non-ferrous metals, the production over year on year is going to decline by not less than 1.5% per year. And therefore, these are signals for the marketplace. Next slide, please. And therefore, if I may very quickly recall what I said, end of 25, early 26, the market then was focused on China approaching its production cap. It had fixed some cap on production, and the market, the Chinese production was reaching its ceiling, and there are other producers in ex-China. Producers were considering closure due to very high power prices. We are now discussing aluminium in 2026. Aluminium is a huge power guzzler, and therefore elsewhere there has been a talk of closure due to very high power costs. And currently, there's a massive power consumption by data centers, for example. Data mining involves extraordinary consumption of energy, particularly electricity. And therefore, because aluminium is a high energy intensive production process, the cost of production actually increases with the increase in energy prices. Even earlier, we were very clear that the aluminium market in 2026 would be in a state of deficit. The deficit would be not less than 200,000 tons, but it can potentially go up to 600,000 tons, depending on closure of smelters, etc. But that's the range in which the deficit was anticipated. Although Indonesia's output has been rising, but the impression was that the pace of increase in output may not be able to offset the near-term tightness. And therefore, we had said in early 2026 that prices may average something like $2,900 a ton in 2026. But look at how the game has changed. The upside risk to outlook that time we had said included stronger demand if global industrial activity picked up. Downside risks was, of course, faster than expected Indonesian supply and whether China's capacity will hold. And increasingly, aluminium is seen replacing copper, particularly wherever lightweighting is required, for example, in vehicles. Therefore, this was a picture that emerged late last year, early this year. But now there is a dramatic change. Let's go to the next slide. Now this market is evolving. Over the last 15, 20 days, there has been a phenomenal change in this market. Now, when we talk of energy intensive production of aluminium, we must remember aluminium will now have to compete. Aluminium production has to compete with data centers and artificial intelligence infrastructure. There's a huge amount of defense spending across regions. And I don't have to explain which are the regions which are now very, very sensitive to military action. And therefore, there's a huge demand for aluminium, but aluminium cost of production stands elevated currently. So mid-February, we all saw how potential US tariff rollback, that there was a possibility, there was a talk, there was a statement. The market was at that time kind of navigating very tight fundamentals. The inventories were low, the trade flows were distorted, but there was no decision on the US tariff rollback. Now, US market certainly structurally remains short of aluminium, which is very clear, and their own domestic smelting capacity has declined because of very, very high power costs. But power is a very significant input for the aluminium industry. Next. Okay, now again, continuing with the evolution of the aluminium market. Now, my own expectation for the rest of the year, taking into account the current geopolitical situation, global supplies are certainly going to remain fairly tight. Inventories are already thin, and we all know that. But you look at the orders, the speculative position stands elevated. Obviously, speculators would come into the market when there is the expectation of a shortage or supply disruption, and therefore there is a huge flow of speculative capital in the derivatives market. And the regional markets are increasingly, obviously, shaped by policy, particularly the United States, etc. Therefore, my expectation is that the LME will keep trading in a mix of fundamentals and momentum. That's how the trading, at least into the foreseeable future, is going to take place, while the US premiums remain the clearest gauge of any policy move. US market aluminium enjoys a premium, but what will happen to the premium will depend on what is the policy, whether the tariffs will be rolled back or not, over which nobody has any control. And therefore, we can only speculate what is going to happen. Middle East, particularly at this point of time, we all have to realize, understand, I'm sure most of us know, it's such a critical place for supply. Production of aluminium accounts for approximately 8 to 9% of the global aluminium capacity. Whether it's Saudi Arabia or UAE, Bahrain, they all rely on the Strait of Hormuz for import of raw material and for export of finished products. And when the Strait of Hormuz is choked, when it is stalled, when ships are not allowed to use it, you can realize the amount of stress that supply chain will face. And obviously, that has elevated the supply risk. And by implication, it has also raised upside price risk as far as aluminium products are concerned. The next one, please. Okay, so the in sum, I would think, at least in the first half of 2026, given current situation, we have to realize, understand, and digest the effect of the West Asia conflict that we talked about. The deficit, in my view, and I fear, is likely to widen. And if it widens, it will have a certain price impact. If the current disruption is short, for example, it's already 15 days, maybe another 3 days, 4 days, 1 week. I don't know. I'm just speculating. Then there will be a certain price impact. But 15 days itself is too long a time. Prices have already actually crossed the levels that I'm talking about, because I wrote these slides at least 4 days ago, 5 days ago. This is 3,300 to 3,400. But a prolonged disruption would take the prices closer to 4,000. I will not be surprised if the conflict were to prolong. It could touch 4,000 or even breach it. I don't track these prices on a daily basis, but I won't be surprised if this were to happen. Therefore, the market is evolving, morphing continually. There are far too many uncertainties, and therefore, as someone who's been tracking global commodity markets for decades, I just have to advise. I want to give a word of caution to all the market participants in the trading. At this point of time, please avoid far forward positions. Don't take a position 3 months, 4 months, 6 months ahead, because we don't know what is likely to happen, because the war outcomes are unclear at this point of time. And therefore, I just thought I'll have a word of caution. Next one, I think I've come to the next slide, please. Yeah, I think I've come to the end of this. As usual, I must give my disclaimer. I'm not a trader. I don't hold any trading position either in the physical market or derivative market. I'm a student of the global commodity market, and it is from there I'm coming. I am a researcher, and therefore my views are those of a student and a researcher. But be careful given the current situation. I would urge extreme caution for those in the trade in taking trading position. Good luck. God bless you all. Thank you.